Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. WBD up 17.5% in the past 5 days. What is going on? We'll take a look at that. Still, remember, if you're a longer-term investor, stock is basically flat in the last 6 months. There's been a bunch of ups and downs. I own this stock. I basically buy it whenever it falls below $7. That seems like a fairly attractive price point for me. I have shares. I have some long-term leaps I bought around that price point as well, so keep that in mind. Last earnings, not very good. Distribution down 9%, advertising down 10%, total revenues down 8%, adjusted EBITDA down 8%. Advertising is challenged because of all of the ad-supported streaming services that are coming out, driving down advertising prices, and essentially more people are cutting the cord. Concern here is that this is their cash cow. This is where they make the majority of their money, and it's shrinking faster than expected. It is a melting ice cube. People are cutting the cord. That's not going to change. Losing, 170 million in EBITDA is not a good sign for a company that needs that cash flow, that EBITDA, to support their debt pay down. They do have a lot of debt. Keep in mind though, debt is actually not too bad. 4.5% overall yield on all their debt. A lot of it is long-term outstanding. They have plenty of time to pay it. I don't think this is a company that's going to go into bankruptcy anytime soon. There is some talk about this benefiting from lower interest rates, but they're not in a spot where they have to refinance their debt anytime soon. So while the stock may benefit from that, I don't think the company benefits from that as much because they've already paid down $16 billion worth of that debt since the merger between Warner Brothers and Discovery. And that's going to continue to be the case. This is kind of the strategy here. Pay down a boatload of debt, get more flexibility with your money. But the problem becomes if you start losing free cash flow because this business is shrinking, you got to make it up somewhere. And the problem is the direct consumer savior that's supposed to be there isn't growing fast enough. Basically flat on the distribution side, growing a bit on the advertising side, but shrinking a lot on the content distribution side. And overall growth on the subscribers count just isn't fast enough, basically only growing by about 3.7 million. Most of those subscribers being international as they expand into more markets. They do have a lot of expansion ahead of them. They're only in about 50 to 60% of the markets they're going to be in from a total accessible subscriber basis. So they're going to expand in a lot of markets, but those are going to be lower average revenue per user markets internationally. And they really have to start getting back to growth on the domestic side. They've actually shrunk by about 1.6 million since Q2 2023. And that is not a good sign. Global ARPU, though, keeps going up. So that's a good sign as they raise prices, but that is leading to lower subscriber counts domestically. My main problem with Max, besides the fact that the name kind of sucks and they're diluting the HBO brand, is the content just isn't fast enough. The pace of content isn't fast enough. House of the Dragon came out. I watched it. It was fine. But then there's really nothing that interests me. There's industry, but like whatever. There's a movie here and there. But Netflix is just churning out content. There's like 3 or 4 new things every week. Whereas Max is like, well, here's a new thing maybe once a month. And I know they're saving money, but that is not a good thing for the development of a long-term brand. Even with House of Dragons, this is your marquee IP. Why are you cutting back the number of episodes from 10 to 8? It's dumbassery to the highest degree. That's all I can say. So what is going on where the stock is up as much as it is in the past 5 days? Well, Charter and WBD signed a new deal, an early renewal agreement that isn't as bad as people expected. When you look at these distribution fees, they make a good portion of their EBITDA from those. Basically, cable companies pay them money to carry their channels. And the worry was that with renewals, those distribution fees would come down because they are losing the NBA. They're losing a marquee sport. That's not decided yet. There's a lawsuit in court, but basically the thought process was that when TNT comes up for renewal, cable companies are going to pay them less money because they no longer have the NBA. Well, this deal basically puts that to rest because TNT renews at the same price it had before, and all of their other channels combined, including TNT, means a bump in carriage fees from Charter Communications, and that is going to set the tone for all of their other negotiations. On top of that, they're doing the same thing that Disney did with their negotiations with the Charter, basically including their streaming services for free for customers of Charter. That may seem like a bad thing when you think about it. Well, if Charter customers are getting Max and Discovery Plus for free, why would they subscribe to those outside of that package? Well, they won't, but maybe it will make them stay with Charter, which is actually a good thing for a company like WBD because they depend a lot on those distribution fees. They depend a lot on advertising from those cable channels, and they want less people cutting the cord, not more, because that's where they make the majority of their money. On top of that, they are including the ad-supported versions of those streaming services, and they want people to be on those streaming services so they can show higher subscriber numbers. They can still make money off of those streaming services, even if they're included for free, because people will watch ads and they're making $7 to $9 per person domestically from those people, which is why they're often giving away those channels at like $1.99 a month because they just want more people, and the more people they get, the more they can charge for advertising on those channels, on those programs. And that's just a good wheel to have to get more people into streaming, even if it's for free, even if it's within this package. And if it helps these cable companies to stay around longer, to stick around longer, to make more money, and therefore give Warner Brothers Discovery more money, that's just a good thing for investors in WBD, because you don't want that ice cube to melt too fast. You want it to melt slowly, because that money is needed to pay down debt, invest more in content, and grow the direct-to-consumer stuff to a point where it's going to be profitable. Speaking of the direct-to-consumer stuff, they talked about how they are still on pace to hit about $1 billion in EBITDA, positive EBITDA, for the direct-to-consumer segment in 2025. And again, that's EBITDA, that's not necessarily cash flow. But if it starts offsetting some of the losses in free cash flow from the linear business, that's a good thing. On top of that, another key piece of news during this conference, this technology conference that David Zaslav shared, is that last quarter they added about 4 million subscribers, with 3.7 million. Now this quarter's additions are going to be even higher. They're going to add more than 6 million subscribers. And again, that's partially because of the Olympics, which they had the rights to in Europe, partially because of the expansion in Europe continuing. And I think that's going to be the norm on a go-forward basis, at least for the next year or two. They're expanding into a lot of countries. They're adding a lot more ad-supported members. And the question mark for me is going to be, how is the domestic service going to do? Because that's where they need to grow. Yes, they're going to grow internationally, but if all 6 million of this growth is internationally and domestic is stagnant, that's where they make the majority of their revenue on the direct consumer side. That's the most profitable area. They need to grow that again. They need to focus on content. Then their movie business is doing okay. You've got Beetlejuice doing pretty well. The Joker maybe will disappoint a little bit based on what I've read, but overall they are trying to get that business to a $3 billion plus business a year. They've got Superman coming out, a lot of stuff going on in that area of the business. It'll be interesting to see what happens. And then their television business is still strong. They are a big television producer, so obviously a good part of their business. Let's look at valuation here. Overall, I think this news is very positive. Doesn't really change my thesis here. My thesis is still about the same. If you want to hear more about that, look at my other videos. But again, video is purely for informational, educational, and entertainment purposes only. It is not investment advice, so keep in mind as we look at this valuation. I haven't really changed my revenue growth assumptions. Even though the carriage fees are increasing, even though there's potential for more additions on the direct consumer side, I still have to see that play out within the earnings. So I'm still kind of assuming shrinking revenue and margins may be improving a little bit for the next couple of years. Buybacks are negative because of stock-based compensation. One thing I would like them to do, I think it would be interesting to show some certainty in the business. If they feel like they're going to generate $4 to $5 billion in free cash flow for the next couple of years, use that to pay down debt, do a small stock buyback. Announce like $1 billion stock buyback. I mean, $1 billion is 5% of the company at this point. That'll show a lot of value in your stock, and really use that money towards something other than just paying down debt, because they have the free cash flow to support that. If they really believe in the business's ability to generate free cash flow for the next 5 to 10 years, they should be able to support something like that, and that would be a benefit to the share price. So I still have a negative 10% buyback here because of the stock-based compensation, but within the next year or two, maybe there'll be an interesting stock buyback or something like that. As I look at the valuation here, I have 50% in a 14% free cash flow yield, 50% in a 13% free cash flow yield. You can kind of play around with this as you'd like. My whole thesis here is this: even if the enterprise value stays the same, they'll pay down $16 billion in debt like they have in the past couple of years. Their market cap basically gets a reward from the fact that they have less debt, that they've become a less risky company, and that leads to essentially a 76% return just on the basis of enterprise value not changing and debt being reduced by quite a bit. So with that in mind, that kind of gets you to a free cash flow yield of about 12, 13%, something like that. On a free cash flow yield, you're sort of converting the enterprise value from being so much in debt into being more on the market cap side. That's kind of where my process is coming from. It's very simplistic. It totally is. I get that. But I believe the market will reward shareholders with a higher stock price if the debt gets reduced to a level where the market's no longer worried about this company going under. And if you think about the enterprise value at 8%, what if the market cap of the company on a free cash flow yield basis eventually gets to an 8% yield? You're looking at a 21% total return from today's price point, even without a stock buyback. With these numbers in mind, you can play around with this. I'll leave the file in the link in the description down below. Hit file, make a copy to use it. I get an expected return of about 8.8% at today's with these assumptions. And again, I think these assumptions are probably very conservative. You can change those if you want. They could certainly get back to growth with the bump in carriage fees, with additional growth on the direct consumer side, with maybe a slowdown in how linear is shrinking. So that gets me to a fair value of about $8.13 if I'm targeting a 10% return, an expected return of about 8.8%. Again, you can totally play around with these free cash flow yields. This is sort of the tricky part with this company. There's so much debt here. There's so many unknowns. It's very risky. And with that in mind, when I buy this stock, I'm sort of targeting a 15% return, which is why I said before, whenever this drops below $7, I get interested, because then it becomes really interesting, really attractive. At 856, there's more risk in it. There's now more information around what's going to happen on a go-forward basis around carriage fees, more clarity around growth potential. They still haven't given any guidance around free cash flow for 2024, which is concerning to me. No guidance for 2025 yet. I think there's still very uncertain times ahead, which is why I'm not like going all in on this stock. Obviously, this can look very attractive if you just look at it from a free cash flow yield basis. You're talking about on a next 12-month basis, a 22-23% free cash flow yield on a market cap. On an enterprise value, it's less attractive at 8%, but I can see how this looks very attractive. I can see how people are very much into the stock because this price point is so low in relation to the free cash flow they generate. But again, that free cash flow is shrinking. They're losing the NBA. There's certainly a lot more clarity today than there was last week around the carriage fees and the deals they're going to sign with cable companies and potential for growth on the direct consumer side. But this is still an unknown for me. You know, this is still a company that's 3 to 4 years from now probably going to look a lot different than it is today. I could see them merging with another larger media conglomerate because there's power in multiples, and realistically their direct consumer service just isn't very competitive yet with Netflix, with even Disney Plus. I mean, Disney Plus I think sucks, but like Netflix is just, they've won the streaming wars. That's essentially what's happened. They've won the streaming wars, and all of these other guys are just playing for seconds. And I don't think Max is doing a good enough job with their content strategy, with their growth strategy to compete for second place yet. And I need to see that change before I really feel good about this investment, because their content just is good, but there's not enough of it. And people just want a lot of stuff in order to stay subscribed for the full year. And I think their packaging with Disney and Hulu and their joint venture on the sports side, all of that stuff is interesting and may reduce churn and may help them grow their direct consumer side, but it still needs to grow a lot faster. This needs to be, 150 million subscribers in a year or two. And I just don't think it's going to get there at the pace they're going. And until I see that domestic side start to grow again, yes, there's going to be international growth because they're expanding into multiple markets every single quarter. That's just going to drive growth naturally, but I need to see more. So let me know what you think down below. Am I wrong on anything? Have I missed anything? Leave a comment down below, like, subscribe, all of that good stuff. Bye.